I need you to think about the last time you made an unusual withdrawal from your bank account. Maybe it was for a car repair. Maybe it was to help a grandchild with something urgent. Maybe it was a medical bill that came in larger than expected. Whatever the reason was, there is a very real chance your bank filed a federal report on that transaction without ever telling you. And here is what makes that matter. That report goes into a database shared with the IRS, the Drug Enforcement Administration, the Department of Homeland Security, and more than 400 other federal, state, and local agencies. It stays in that database for 5 years. And every future financial transaction you make gets automatically cross-referenced against it. I am going to show you exactly what triggers that report, exactly which 7 normal things seniors do with their bank accounts that land them in that database, and exactly what you can do right now to protect yourself before the next transaction puts your name in a system you never knew was watching. There is a federal database that your bank has access to right now. It was built in 1970 to track drug traffickers, money launderers, and organized criminal enterprises. It was expanded after September 11th of 2001 to also monitor potential terrorist financing. It has been updated repeatedly over the past 50 years to incorporate new technologies, new payment systems, and new patterns of financial behavior that the government wants to monitor. And in 2026, it is being filled day after day, month after month, with reports on ordinary American retirees who withdrew money to buy a hearing aid, who received cash from selling a car, who sent money to a child for a down payment, who paid a contractor with multiple checks for a home repair, or who deposited proceeds from selling personal property they no longer needed. The database is run by a federal agency called the Financial Crimes Enforcement Network. Most people have never heard of FinCEN. Most people have never heard of the Bank Secrecy Act database that FinCEN operates. Most people have no idea that 2 separate types of federal reports can be filed on their bank account without their knowledge and without any notification to them whatsoever. The first type of report is the currency transaction report. Your bank is required by law to file a currency transaction report automatically and without exception anytime you conduct a cash transaction that totals more than $10,000 in a single business day. The report includes your full legal name, your social security number, your date of birth, your home address, the amount of the transaction, the type of transaction, and the exact time it occurred down to the minute. The bank must file it within 15 days. You will never see a copy. The bank is not required to tell you it was filed. The second type of report is the suspicious activity report. Unlike the currency transaction report, which has a fixed dollar threshold, the suspicious activity report has no minimum dollar amount at all. A bank can file a suspicious activity report on a transaction of any size, $100, $500, $2,000 at any time, based entirely on their internal compliance team's judgment that the transaction fits a pattern their software has flagged as unusual. The report goes into the exact same federal database as the currency transaction report. You will never be told it was filed. You have no legal right to know, and if a bank employee tells you that a report was filed on your account, that employee has committed a federal crime called tipping off, which carries a penalty of up to 5 years in federal prison. That is the system. And the system was not designed for ordinary retirees. But the system is catching ordinary retirees in enormous numbers because the threshold that defines what triggers a report has been frozen at $10,000 since the year 1970. While the normal everyday financial transactions of a normal retired American have grown to be 3, 4, and 5 times larger in real dollar terms over the same period. A knee replacement copayment, a kitchen renovation, a used car purchase, a down payment gift to a grandchild, an insurance payout, a lump sum pension rollover, all of them routinely cross $10,000 in 2026. All of them can trigger a federal report. None of the people making those transactions believe for a moment that they are doing anything that belongs in a federal law enforcement database. In 2023, the most recent year for which complete data is available, banks filed 4.6 million suspicious activity reports. 4.6 million. That is more than 12,000 per day. On top of the currency transaction reports filed for every cash transaction above $10,000. Most of those reports go nowhere. They sit in a queue. They are reviewed by no one, but they are there, with your name on them, cross-referenced against everything else you do financially for the next 5 years. And here is what I need you to understand before I walk through the 7 things that trigger these reports. The existence of a suspicious activity report in the FinCEN database is not a criminal charge. It is not an indictment. It is not even an allegation of wrongdoing in the formal sense. It is a flag, a data point, a marker in a system that says something about your transaction pattern looked unusual to the compliance software at your bank. For the vast majority of retirees who land in the database, nothing will ever come of it. No one will call. No one will come to the door. The report will sit in the database for 5 years and then it will expire, and you will never know it was there. But for a smaller number of retirees, the report becomes the first step in a sequence that can lead somewhere very uncomfortable. A denial of a loan at a different institution, a freeze on a future transaction, a civil asset forfeiture action that seizes money from an account before any criminal charge is filed, a referral to the IRS Criminal Investigation Division that begins an audit the retiree was not expecting. None of those outcomes are guaranteed from a single suspicious activity report. All of them are possible. And knowing the 7 things that trigger the report in the first place is the only protection available to an ordinary person operating inside a system that was not built with them in mind. Let me tell you about a client of mine before I walk through the list. I'm going to call him Walter. Walter is 72 years old. He lives outside of Cincinnati, Ohio. He spent 34 years as a production supervisor at a packaging company. He retired at 68. He's not wealthy. He's careful. He has Social Security, a small pension, and a checking account at the same community bank he has used since 1987. He has banked there for 35 years. He knows the tellers by name. They know him. He has never had a problem. Well, last summer, Walter decided to replace both of his hearing aids. The audiologist his doctor referred him to did not accept insurance for the devices themselves, only for the fitting and the programming. The out-of-pocket cost for both hearing aids together was $6,400. Walter went to his bank on a Tuesday morning and withdrew the money in cash because he was not certain whether the audiologist's office accepted checks, and he did not want to deal with any complications at the appointment. 3 weeks later, Walter sold a riding lawnmower he no longer needed because he had moved from a house with a large yard to a smaller property. The buyer paid him $4,200 in cash, and Walter deposited the money at his bank that afternoon. 3 weeks after that, Walter sold his old pickup truck to a private buyer he found on an online marketplace. The buyer gave him $2,800 in cash, and Walter deposited that amount at the bank the same day. Walter did not think about any of these 3 transactions as a pattern. They were 3 separate events that happened to occur over a 6-week period, a purchase and 2 sales, all of it completely legitimate, all of it involving his own money for straightforward and explainable reasons. What Walter did not know, and what nobody at his bank had ever explained to him in 35 years of being a customer, was that his bank's compliance software had flagged all 3 transactions and filed a suspicious activity report with the Financial Crimes Enforcement Network. The $6,400 cash withdrawal was flagged because it broke his historical pattern. Walter had never in his account history withdrawn more than about $1,500 in a single transaction. A $6,400 cash withdrawal deviated sharply from his established baseline, and the software scored it as a pattern break. The 2 deposits were flagged separately and then flagged together. Each individual deposit, $4,200 and $2,800, was below the $10,000 currency transaction report threshold. But the software detected that 2 deposits totaling $7,000 had arrived within a 30-day window following a large cash withdrawal from a customer whose account history showed no prior pattern of significant cash deposits. That combination of factors scored above the threshold that triggers a suspicious activity report under the bank's compliance protocols. Walter found out about the report 14 months after it was filed. He had applied for a home equity line of credit at a different bank to cover some property improvements. The loan was declined. He called to ask why. A compliance officer at the new bank told him, more than she was technically authorized to share, that there was something in his financial background check that was generating a review flag, and that she could not tell him more than that. Walter called me. We spent 2 weeks trying to understand what had happened. Eventually, through a combination of reviewing his account history and understanding the patterns that trigger suspicious activity reports, we pieced together what the software had flagged and why. Walter was never charged with anything. He was never investigated by any federal agency. He was never contacted by anyone from FinCEN, the IRS, or any law enforcement organization. He simply has a suspicious activity report in the federal database with his name, his social security number, his address, and a description of 3 transactions that the software at his community bank decided looked suspicious. That report will be there until 2028 or 2029, cross-referencing against everything he does financially in the meantime. Walter sold a lawnmower and a truck and paid for his own hearing aids with his own money. He is in a federal database because of it. That is what this video is about. My name is Marcus Steele. I am an enrolled agent licensed by the federal government to represent taxpayers directly in front of the Internal Revenue Service. I sit across the table from the IRS on behalf of real clients. I work with retirees every week on tax planning, retirement income protection, and the kind of financial situations that most people never know they are in until someone explains the system they are operating inside. And the system I am about to describe to you is the one that catches more ordinary seniors every year, that almost none of them understand before it catches them, and that is entirely possible to navigate safely once you know the 7 things that trigger it. Let me walk through them one at a time. The first thing that flags a senior's bank account is a withdrawal or deposit that breaks their established historical pattern. Bank compliance software is not primarily a dollar threshold system. It is a pattern recognition system. The software builds a model of each account holder's normal financial behavior over time, how much they typically withdraw in a week, what their average deposit looks like, how often they interact with the account, what their typical transaction sizes are. That baseline model is the standard against which every new transaction is measured. When a transaction deviates significantly from the baseline, the software scores the deviation. The score determines whether a suspicious activity report gets filed. And the key point that almost no retiree understands is that the deviation does not have to be large in absolute dollar terms to produce a high score. A retiree who has withdrawn an average of $300 per week for the last decade and who suddenly walks in and asks for $5,000 will score higher on the deviation metric than a retiree who has always had variable account activity and withdraws $8,000 one week. The practical implication of this is counterintuitive. Seniors who have been the most consistent, most predictable, most responsible account holders over the longest periods of time are often the ones who get flagged most dramatically when life requires them to make a transaction outside their normal pattern. The very consistency that signals responsible banking becomes the tripwire that sets off the compliance software when a legitimate but unusual transaction occurs. A retiree who has never withdrawn more than $2,000 in a single transaction and who needs $6,000 for a medical procedure that is not covered by insurance is not doing anything wrong. But in the context of their account's own history, the software sees a 3-to-1 deviation from the established maximum. That deviation gets scored. That score gets reported. The second thing that flags a senior's bank account is multiple deposits that add up to an amount near the $10,000 reporting threshold when viewed together over a short period. This is called structuring, and it is one of the most misunderstood legal concepts in the entire Bank Secrecy Act framework. Under Title 31 of the United States Code, Section 5324, it is a federal felony to deliberately break a transaction into smaller amounts for the purpose of evading the $10,000 currency transaction report requirement. The maximum penalty is 5 years in federal prison plus forfeiture of the entire amount involved. The Institute for Justice, a public interest law firm that has taken on many of these cases, has documented dozens of situations where innocent Americans had their entire bank accounts seized under structuring laws without ever being charged with a criminal offense. A family grocery store on Long Island had $446,000 seized because the owners made deposits just under $10,000 to stay within their insurance policy's on-premises cash limit. A dairy farmer in Maryland had his entire operating account seized for the same reason. A convenience store operator in Iowa lost $32,000 overnight. None of those people were ever convicted of any crime. The money was taken through civil asset forfeiture, which does not require a criminal conviction. You have to prove your innocence to get it back, while the government holds your money during the process. In 2024, the pattern detection algorithms that banks use to flag potential structuring were upgraded significantly. The threshold at which those algorithms now flag transactions has dropped substantially. If you are making regular deposits of $6,000, $7,000, or $8,000, and those deposits are spaced in a way that could be interpreted as an attempt to stay under the reporting threshold, your account is now being flagged. Not necessarily prosecuted. Flagged. That flag triggers a human review, which can trigger a suspicious activity report, which enters the FinCEN database, which can eventually be cross-referenced by an IRS criminal investigation agent reviewing your tax return. For ordinary retirees who are receiving multiple payments over a short period, the proceeds from selling personal property, the payments from a tenant in a rental, the installment payments from someone who bought a vehicle from them privately, the risk of inadvertently appearing to structure deposits is real and almost entirely invisible until after the report has been filed. The third thing that flags a senior's bank account is the first wire transfer from an account that has not previously sent or received wires. Wire transfers are the fastest and most common method criminals use to move money out of accounts they are exploiting. Because of that association, compliance software treats the first wire transfer from a historically wire-free account as one of the highest risk individual transactions in the entire flagging system. The risk score for a first wire transfer is high, regardless of the dollar amount, regardless of the destination, and regardless of whether there is any other suspicious activity in the account's history. The software cannot distinguish between a retired school teacher wiring $35,000 to a car dealer for a vehicle she is purchasing and a fraudster wiring $35,000 out of an elderly woman's account after gaining her trust through a phone scam. Both transactions look identical to the algorithm. Both get flagged for human review. What happens next depends on what the human reviewer finds when they look at the account. If the retiree pre-notified the bank, if there's a note in the file explaining that a wire transfer to a specific payee for a specific purpose is expected. The reviewer sees the explanation and closes the case without escalating. If there is no note, the reviewer makes a judgment call with no additional context. In many cases, they file the suspicious activity report to be safe, because the penalty for failing to file a report when one was warranted is severe, and the penalty for filing a report unnecessarily is zero. A retiree who has never wired money before and who needs to send a significant amount should call their branch manager before the transaction. Give them the payee's name, the amount, and the purpose. Ask them to note it in the customer file. That 5-minute phone call changes the outcome of the human review that will follow the wire. The fourth thing that flags a senior's bank account is cash deposits made by a third party on the account holder's behalf. If your son or daughter walks into your bank branch and deposits cash into your account while you are not present, the bank logs it as a third-party cash deposit. Third-party deposits above a few $1,000s generate an automatic review flag in most institutions. This is because third-party cash deposits are a common mechanism in elder financial exploitation schemes where a person who has gained influence over an elderly account holder deposits funds from the exploitation into the victim's account before transferring them out. The compliance software cannot distinguish between a legitimate third-party deposit and an exploitation-related one. It flags both. The same is true of cash deposits made at branches other than your home branch, deposits made through a night drop box after business hours, and deposits made in the final minutes before the bank's closing time. Any of those patterns add risk score points to the transaction and can push it above the threshold that triggers a report. If you regularly have a family member handle banking transactions on your behalf because of health, mobility, or geographic reasons, establishing a formal documented arrangement with your bank in advance, a power of attorney on file, a named authorized representative, a note in the account explaining the arrangement, reduces the risk score assigned to those transactions significantly. The fifth thing that flags a senior's bank account is round number transactions in amounts just below the $10,000 reporting threshold, a withdrawal of exactly $9,000, a deposit of exactly $8,500, a series of transactions that each come in at precisely $8,000 or $9,000 or $9,500. The compliance software is specifically trained to look for clean round numbers near the reporting threshold, because that is the signature pattern of someone who knows the threshold exists and is deliberately trying to stay under it. The pattern is called threshold awareness, and it is one of the specific behavioral indicators that bank examiners are trained to identify. The irony that catches many innocent people is that the very act of being cautious, of trying to keep transactions below what feels like a reporting line, is itself the most reliable signal to the algorithm that deliberate structuring is occurring. A transaction of $9,420 looks less structured than a transaction of exactly $9,000. The clean round number is the tell. For retirees who have some awareness of the $10,000 rule and who have been making decisions about transaction sizes based on that awareness, the risk is that those decisions are producing the exact pattern the algorithm is searching for. The safe approach, which I will cover in the protection moves section, is to move the full legitimate amount in a single transaction whenever possible, even if that amount triggers a currency transaction report, rather than splitting or adjusting amounts to avoid reporting. The sixth thing that flags a senior's bank account is activity that does not match the account holder's known income profile. Every bank has information about its customers' income on file. The income used to open the account, the Social Security direct deposit amounts, the pension payments, the regular monthly deposit patterns. The compliance software builds an income expectation model from that history and flags deposits that are inconsistent with the expected income level. A retiree on Social Security depositing $15,000 from cashing out a matured savings bond, liquidating old stock certificates that have been sitting in a drawer for 30 years, receiving an inheritance payment from a deceased parent's estate, or collecting on a life insurance policy will get flagged for an income mismatch even if every dollar is completely legitimate and fully explainable. The fix for this category is documentation and prepared in advance, rather than after the flag is filed. If you know a large deposit is coming from an unusual source, have the supporting documentation ready before the deposit arrives at the bank. The savings bond redemption confirmation from Treasury Direct, the brokerage statement showing the stock sale, the executor's letter and probate documents from the estate, the insurance company payment confirmation letter. When the compliance officer reviews the flag, those documents sitting in front of them are what closes the case without escalation rather than extending it. A retiree who arrives at the bank with a check for $15,000 from an insurance payout and simultaneously presents the insurance company's payment letter is a fundamentally different review case than a retiree who deposits the same check with no explanation. The transaction is identical, the outcome of the review is not. The seventh thing that flags a senior's bank account is consistent use of digital payment platforms that pushes total receipts above the new federal reporting thresholds. This one is the newest on the list and the one that is catching the most people who have no idea it applies to them. Beginning with tax year 2025, every major peer-to-peer digital payment platform in the United States, including Venmo, Zelle, Cash App, and PayPal, is required to issue a Form 1099-K to any account holder who receives more than $600 in a calendar year from goods or services transactions. That threshold dropped from $20,000 in 2022 to $5,000 in 2024 to $600 beginning in 2025. $600. A retiree who receives $650 through Venmo from a grandchild for splitting a vacation expense, $250 from a neighbor who bought a piece of furniture, and $300 from someone who purchased an item they listed online has received $1,200 in transactions that the platform is now required to report directly to the IRS on a Form 1099-K. That form goes directly to the IRS automated matching system. If the amount on the 1099-K does not appear on the retiree's tax return, the system flags a discrepancy automatically. It can trigger an audit notice. The digital payment platform situation is made more complicated by the fact that Zelle, which is operated directly by the major banks and runs transactions through the banking system rather than through a separate platform, is now subject to the same Bank Secrecy Act reporting requirements that apply to traditional bank transactions. A Zelle transfer of $12,000 to a child for a down payment goes into the same FinCEN database as walking $12,000 in cash into a branch. Same report category, same database, same 5-year retention period. Most retirees who use Venmo or Zelle to receive money from family members, to sell items they no longer need, or to split expenses with friends, have no idea that their digital payment activity is now part of the same federal reporting infrastructure that was built in 1970 to catch drug traffickers. Now, I want to talk about what actually happens when your account gets flagged, because most people imagine the process is more dramatic than it actually is, and that misunderstanding leads to the wrong kind of preparation. When your bank files a suspicious activity report, the report goes into the FinCEN database. It is assigned a case number. It sits in a review queue along with 4.6 million other reports filed that year. Approximately 4% of suspicious activity reports receive any follow-up action at the federal level. The other 96% sit in the database, are retained for 5 years, and then expire without anyone ever looking at them. That sounds reassuring. But the 4% that receive follow-up action represent approximately 184,000 cases per year at current filing volumes. And the retirees in those cases did not know in advance that they would be in the 4% rather than the 96%. They found out when something happened that they did not expect. A denied loan at a new institution, a frozen transaction, a letter from the IRS, a civil asset forfeiture notice. The more significant ongoing risk is not the initial review of the report. It is the cross-referencing. Every future financial transaction you make, every subsequent deposit, every withdrawal, every wire transfer, is now being measured against the existing flag in the database. A second flag filed, while the first one is still active, produces a different response than a first flag filed on a clean account. The risk score assigned to future transactions is higher. The threshold for triggering a human review is lower. The likelihood of escalation increases with each additional data point that reinforces the initial flag. This is the cascade that Walter is living inside right now. He has one suspicious activity report in the database. It expires in 2028. Until then, every transaction he makes at any bank, because the database is shared across financial institutions, carries a slightly elevated risk of triggering a second review based on the pattern context the first report established. He sold a lawnmower and a truck. And for the next 2 years, he has to think more carefully about his banking activity than he ever had to think about it before. Now, let me give you the 5 protection moves that dramatically reduce your exposure to every one of these 7 triggers. These are not complicated moves. They do not require a lawyer or a financial advisor. They require information and 15 minutes of your time before any significant banking transaction. Protection move number 1 is to pre-notify your bank before any transaction above $5,000. Call your branch manager directly. Not the main customer service line, your branch. Give them your account number, tell them what the transaction is for, the amount, and when you expect to make it. Ask them to note it in your customer file. This single move eliminates the majority of suspicious activity report filings for ordinary retirees. When the transaction triggers the compliant software, which it still may, the human reviewer who looks at the flag sees the note immediately. The note explains the deviation from pattern. The reviewer closes the case without filing. You never enter the database. The transaction that takes 15 minutes of pre-notification takes the same amount of time with the note in place as it does without it. The outcome is completely different. Without the note, a $6,000 cash withdrawal lands in a federal database. With the note, it is processed as a routine transaction from a customer whose reason was documented in advance. Protection move number 2 is to never break a single legitimate large transaction into multiple smaller ones. If you need to deposit $14,000 from a property sale, deposit the full $14,000 in a single transaction. The $14,000 deposit triggers an automatic currency transaction report that goes into the FinCEN database without any human review. That report is routine. It is not scored as suspicious, and for a retiree with no other flags in their history, it leads to nothing. The CTR simply exists in the database as a record of a large cash transaction. The same $14,000 deposited as two $7,000 transactions on different days triggers the structuring algorithm. The structuring flag gets scored against your account history. The human reviewer who looks at the structuring flag is looking for a different kind of pattern than the one who looks at a CTR. The suspicious activity report that gets filed from a structuring review is a fundamentally different and more serious document than the routine CTR from a single large transaction. The currency transaction report that feels scary because of the dollar threshold it triggers is actually the safer path for a single legitimate transaction. It is automatic. It is routine. It is filed on millions of people every year without any consequence to the account holder. The structuring flag is not routine. It is the result of a judgment call by compliance software and a human reviewer that something wrong may be happening. Protection move number 3 is to use wire transfers and cashier's checks rather than cash for large payments wherever possible. The Bank Secrecy Act reporting requirements were designed around physical cash. The assumption baked into the law in 1970 was that large amounts of illicit money would move in cash. Wire transfers and cashier's checks create paper trails that document the source and destination of funds, which is exactly the kind of transparency that reduces compliance risk. A retiree who pays a contractor $40,000 in cash is creating a situation where the contractor is required to file a Form 8300 with the IRS, identifying the payer, and where the retiree's bank will also flag the large cash withdrawal. A retiree who pays the same contractor $40,000 by wire creates a clear, documented record of the transaction that both the bank's compliance system and any future reviewer can trace completely. The wire may still trigger a first wire from this account flag, which is why pre-notification matters, but the overall risk profile of the transaction is significantly lower than the cash equivalent. Some contractors and private sellers prefer cash. In those situations, using a cashier's check, which can be purchased from your bank and which creates a bank record of the transaction, is the next best alternative to a wire. The cashier's check documents the amount, the payee, and the date, and it leaves a clear paper trail that explains the cash outflow from your account to any compliance reviewer who looks at the transaction history. Protection move number 4 is to maintain a written record of every transaction above $5,000, not a formal accounting ledger. A simple notebook is enough: a date, an amount, a source or destination, and a one-sentence description of the purpose for each transaction, consistently, before you need it. The reason this matters is not to protect you from an audit. It is to protect you in a civil asset forfeiture proceeding, which is the specific mechanism that has cost innocent Americans the most money in the Bank Secrecy Act enforcement context. Civil asset forfeiture does not require criminal conviction. It requires the government to show that the money was connected to an illegal transaction. The burden of proof is on you to show that it was not. If you can produce a notebook entry that says, May 15th, 2026, deposited $40,200 cash, proceeds from sale of John Deere riding mower to buyer named Robert Haynes, phone number on file, that entry combined with any supporting documentation you kept is the foundation of your defense in a civil forfeiture action. Without that documentation, you are relying on your memory and on a government reviewer's willingness to take your word for it after the fact, under circumstances where your money may already be frozen. Write it down every time before you need it. Protection and move. Number 5 is to keep your address current with every financial institution you use and with the IRS. If a compliance review leads to a formal inquiry, the government sends notices to the address on file. A notice that goes to an old address is a notice that starts a response clock you did not know was running. Missing a response window in a compliance inquiry is not the same as missing a response window in a routine letter. In some contexts, failing to respond to a government inquiry within the specified window is treated as evidence of non-cooperation, which changes the tone and direction of what follows. File Form 8822 with the IRS anytime you move. Update your address directly with your bank at the same time. Update your address with every financial institution you have a relationship with, including accounts you do not use frequently, retirement accounts, savings bonds registered at Treasury Direct, any account where a government or regulatory communication might be sent. The 15 minutes it takes to update your address across every institution you have a relationship with is the protection that ensures any official communication reaches you in time to respond. I want to come back to Walter before I close, because his story does not end with the federal database, and it does not end with a problem. Walter spent 2 weeks after he called me reconstructing the documentation for the 3 transactions that had been flagged. He had the audiologist's receipt for the hearing aids. He found the private sale listing he had posted online for the lawnmower and the buyer's contact information from the messages they had exchanged. He had the title transfer paperwork from the truck sale. He put all of it in a folder with a written summary of each transaction. 3 pages, covering 3 events. That documentation cannot remove the suspicious activity report from the FinCEN database. The report stays until it expires. But Walter now has a complete contemporaneous explanation of every transaction that was flagged, ready to produce immediately if any future inquiry arises. He pre-notifies his bank before every transaction above $5,000. He has not had a flag generated on his account since he started doing that. He told me something at the end of our last conversation that I want to leave you with. He said, "I banked at the same place for 35 years. I thought they knew me. I thought that counted for something." It does count for something with the tellers who have known him for years. It does not count for anything with the compliance software that runs every transaction through an algorithm that does not know his name. The human relationship is real. The automated system that operates alongside it is not aware of the human relationship. Both of those things are true at the same time. Knowing that both things are true is the only protection available to an ordinary retiree navigating a system that was not built for them, that was never explained to them, and that operates in complete silence on the other side of every transaction they make. You now know the 7 things that trigger the reports. You now have the 5 protection moves. The pre-notification phone call takes 5 minutes. The notebook entry takes 30 seconds. The address update takes 15 minutes once. None of these moves require anything complicated. All of them can change the outcome of a transaction that would otherwise land your name in a database you never knew was watching. Before I close, I want to give you something to take with you. I put together a free resource, my 2026 Bank Account Protection Checklist for Seniors. It covers all 7 transaction types that trigger flags, with the specific patterns and dollar ranges for each, the pre-notification protocol including the exact language to use when you call your branch manager, the documentation template for transactions above $5,000, the wire transfer and cashier's check guidance for large payments, the digital payment platform reporting thresholds and Form 1099-K requirements for 2026, and the 5 protection moves laid out as a single reference card you can keep with your important financial papers. Every item includes the specific action and, where applicable, the form or phone number to use. To get it, go to marcusgravestacks.com/checklist. The link is in the description below this video. Print it out. Start the notebook this week before the next transaction that might cross the threshold, and make the pre-notification phone call the next time you need to move a meaningful amount of money through your bank account, because the protection that costs the least, a 5-minute call and a notebook entry, is the protection that makes the most difference when the compliance software flags a transaction you never expected anyone to look at twice. Here's what I want to leave you with. The Bank Secrecy Act was signed into law in 1970. At that time, $10,000 was more than the median American household earned in an entire year. The threshold was designed to catch extraordinary transactions. In 1970, depositing $10,000 in cash was an extraordinary thing for an ordinary person to do. In 2026, a knee replacement, a kitchen remodel, a used car, a down payment gift, an insurance payout, a lump sum pension rollover, all of them routinely cross $10,000. The transactions that trigger federal reports are no longer extraordinary. They are ordinary. They are the financial events of a normal retirement. The threshold has not moved, not once, in 56 years, which means the system that was built to catch extraordinary financial activity is now running its algorithms on the ordinary financial life of every senior in America. And the seniors who know how the system works are the ones who can protect themselves. The ones who do not know are the ones who end up like Walter in a federal database they never knew existed for selling a lawnmower and replacing their hearing aids. You know how the system works now. Send this video to one person you know who is over 65 and still banks primarily in cash, or who has made any significant unusual transaction in the last year without pre-notifying their bank. That person is where Walter was before he called me. One share from you today could be the thing that keeps their name out of a database they will never know they're in until something goes wrong. That is what this channel is here to do. I will see you in the next one.